Well, our next guest says that oil will average $70 a barrel this year, and so far, he's right on target. Here to tell us which factors are playing the strongest role in price is Adam Sieminski. He is chief energy economist at Deutsche Bank. Adam, so glad to have you with us this morning. Thanks for joining us.
Deirdre.
So the high price for oil this year has been close to $87 a barrel. Now, since the credit crisis in Europe, the price has come much lower. How much are these sovereign debt worries worth as far as price per barrel in crude?
Yeah, well, I think that was one of the factors, and it's really changed sentiment. The other two things that have been going on, the credit tightening in China, which calls into question exactly how fast oil demand is going to grow in that country. And on top of that, for the last several months now, oil inventories have been climbing. All three of those things taken together, I think, are shifting people's views about what the drawdown in OPEC spare capacity will be over the next year or two. That's brought oil prices down.
So, Adam, if you say that the credit crisis in Europe is the #1 factor, I mean, is it possible to quantify it? It's a kind of an annoying question, but I mean, in percentage point terms or dollar per barrel, is it possible to calculate the weight?
Well, if we said that oil prices have come down $20 since the beginning of May, I'd say probably half of that would be attributable to the credit crisis, a sovereign debt crisis, and the other half, those other two factors.
Now, in your research, you say it's likely that the U.S. gets into another debt crisis. How likely on a scale of 1 to 10? I mean, PIMCO weighing in this morning talking about this ring of fire. I mean, PIMCO even suggesting buying Mexican, Russian, or Brazilian debt instead of U.S. debt.
Well, I think there's a long-term problem for the U.S. because of, the fact that we have expenditures growing faster than tax collection here. But it's probably not going to be critical in the very short run. Even in Europe, the Portugal and Greece together only account for about 4% of GDP in Europe. So I think that they can probably take care of this situation in the short run. I think what's happened is the view that investors have had about how rapidly the economy can recover and how long that's going to be sustained has shifted, and it's that change in sentiment that has weighed on crude oil prices.
But, as far as the U.S. looking at a situation that not is as damaging as Europe, because that seems unlikely, but based on your research, would you say on a scale of 1 to 10, it's as high as a 5?
Well, I think that you have to come back to the oil markets, and rather than trying to attribute the debt or the tax issues in the U.S. or Europe to oil prices, what you have to say is, what's the likely supply and demand balance over the next 2 or 3 years? And I think that what's been going on there is people had a view that the 6 million barrels a day of spare capacity in OPEC would get used up, literally completely used up in the next 3 years, and that had to send oil prices into triple-digit territory. Now it looks like that winding down of OPEC spare capacity is going to take a lot longer, and that's brought oil prices back down to where the Saudis and others have said that they're comfortable with them from a number of different standpoints, and that's in that $70 to $80 barrel range.
Adam, we thank you as always. Adam Sieminski joining us there. He is the chief energy economist at Deutsche Bank.